Texas Instruments reported lower earnings in their full year 2023 financial results. The technology firm cited weakness across industrial and a sequential decline in automotive customers as the primary cause. Revenue was down 12.5% to $17.5 billion, with the lowest gross margins of 63% seen for at least 6 years. Operating margins were also down year over year by $7.3 billion, or about 42% of revenue. The bottom line came in at $6.5 billion, lower by 26% compared to full year 2022. Looking at the 5-year income bar chart, revenue is down from its peak in 2022, though growing on a 4% compound basis. Gross profit has been growing at a 3.8% rate since 2019. Both operating profit and net income have been growing by 5% in the same period. The 3-year compound annual growth rate doesn't paint such a rosy picture, with revenue contracting by 1.5%, gross profit by 3.8%, operating profit by 6.5%, and finally net income down nearly 6%. The business segment revenue, however, shows a mixed result. Their analog business, by far their largest product line, ended 2023 at $13 billion with a compound annual growth rate of 5%. But a 3-year growth rate of negative 2.5%. The embedded processing business has continued to grow since 2019, with record revenue of $3.4 billion, increasing 2.7% and 3.4% in the last 5 and 3 years respectively. Despite the growth, operating profit was down by 20% year over year, however. A closer look at revenue by country continues to show China as the dominant market, but that seems to be changing. Just to note that revenue by country for full year 2023 wasn't provided in their financial statements and are our estimates. While all markets for Texas Instruments have been growing for the last 5 years, China seems to be losing its appeal, with business contracting by 5% in the last 3 years. The United States has been the slowest growing market for the last 5 years at only 1.6% since 2019. The rest of Asia, which is ex-Japan and ex-China, has been growing at 10% for the last 5 years. The Europe and Middle East geography continues to be Texas Instruments' second largest market, finishing 2023 at over $3 billion in revenue, growing at around 3%. Let's turn to the valuations and financial ratios. Shares outstanding were lower by 1%, or 10 million shares, compared to 2022. Earnings per share were $7.07, down 29%. Sales per share were down 12% to $19.10 per share. Cash per share came in at $3.24, slightly lower year over year. Book value is a bright spot, increasing 17% to $18.45. Equity increased by $2.3 billion. Price earnings for Texas Instruments is 23.9 compared to the S&P 500 at 26.54. In line with market valuations, but revenue and margin growth decreasing suggests TI is overvalued. PE growth is negative 0.9. The leverage ratios have the debt ratio at 0.33, which is slightly improved as total assets increase faster than long-term debt. Debt to equity at 0.63 was better by 11% as well. Interest coverage at 20.8 times shows that Texas Instruments is more than capable of covering interest payments on its debt. Liquidity ratios are impressive, with current ratio at 4.55, the quick ratio at 3.12, and the cash ratio at 0.89. Return on assets at 20% is good, though down by 37% year over year. Return on equity at 38% is also good, but lower by 36%. Texas Instruments has an equity multiplier of 1.9. Return on capital employed was 25%, and return on invested capital was just 7%. The cash flow numbers look good, with operating cash flow at $6.4 billion. Investing outflows were $4.4 billion, boosted by capital expenditures. Financing outflows were $2.1 billion, largely from issuing new debt, which was used to boost capital expenditures, we presume. Free cash flow to the firm was a healthy $3 billion. Texas Instruments paid $5 in dividends last year, or about a 3% yield. Growth was 7.2%. The firm has a good track record for dividend payments, saying that it has been growing at 25% on a compound basis since 2004. Enterprise value for Texas Instruments is about $162 billion, which is a 9.25 multiple to revenue and a 54 multiple to cash flow. Market capitalization to net income is 24 times. Guidance provided by the company was not all that great. They only provided quarterly guidance, and as such we put in a quarterly bar chart to illustrate the details. They claimed revenue for Q1 2024 would be 3.45 to 3.75 billion, lower by more than 10% from Q4 2023. Earnings per share are expected to be between 96 cents and $1.16. Based on the current shares outstanding, that puts net income under $1 billion for the quarter to $970 million. If we annualize the EPS, the firm is trading at a forward PE of 40. The key takeaways on the pro side is that Texas Instruments has a good cash flow. The fundamentals look good too. We like that research and development and capital expenditure spend has increased this year, so the firm is investing in the future. A 3% dividend yield is good, but on the con side we see revenue continue to weaken, margins continue to weaken. The PE is too high based on the revenue picture. Inventory is at a peak of $4 billion. They're going to have to slash prices or take a write-off to clear out the warehouse. We give Texas Instruments a sell to neutral rating. The share price will have to go lower to bring its PE in line with earnings. The research and capital investments will need some time to bear fruit, and a 50% write-off in inventory would take another $2 billion off net income. The dividend yield is good though. We have no exposure to this company. Like and subscribe.